Hey everyone, I want to talk about the rise of zombie companies because we have a big problem in our economy with companies that just won't go away even though they are not doing what they need to do to survive. So this headline, highly indebted zombie companies control more than 2 million U.S. jobs. What is a zombie company? It's a company that continues to borrow money even though they can't pay their full debts. So these are companies that are not selling whatever good or service they produce. They're not earning enough revenue from their sales in order to pay back the money that they've borrowed with interest. But yet, they stay alive. These companies occupy a large swath of American industry, and they, once again, are companies that continue to operate even though they do not have the revenue stream to pay off their debts. These are the industries in which zombie companies control the most jobs. The largest number of jobs controlled by zombie companies are from the industrial conglomerates. And then you can see we have 233,000 jobs controlled by the zombie companies in the industrial conglomerate category. And then you look at hardware and storage companies, energy companies, or companies that produce equipment and energy services, hotels, restaurants, software, auto components, food, IT, and you have lots of industries, each controlling tens of thousands, and in the case of the industrial conglomerates, hundreds of thousands of jobs are basically in danger because the company that has those jobs is not making enough money to sustain themselves. And you wonder why they don't just go bankrupt, because a zombie company is basically a dead company that is being kept alive by someone. And of course the answer to that is the Federal Reserve. Some of the biggest names have actually found it easier to raise more debt during the present crisis as a Federal Reserve intervention has breathed new life into the corporate bond market. Their stock prices have also rebounded aggressively. So corporations that need to borrow money sell bonds, and whoever buys those bonds is lending the corporation money so that the corporation can pay its bills. The corporation pledges to pay back the money with interest. The buyer of corporate bonds in this case has been largely the Federal Reserve, which used to not buy corporate bonds. Used to just make loans to banks, and then the banks would take some of that money and lend it back to corporations who wanted to borrow. But now, because of the recent crisis we have in America, the Federal Reserve has decided to jump into buying corporate bonds. So they are lending directly to companies. And the stock prices of many of these dead zombie companies has risen because investors believe the company will survive because the Federal Reserve has their back, even though the company is making too little revenue to pay its bills. One of the reasons why the stock market rises is because when the Federal Reserve makes money easy by keeping interest rates low, it makes it to companies borrow money for nothing. And since the money costs them nothing, they can do whatever they want with it. So as we've seen over decades, professional traders have used leverage money, that means debt, to invest in ETFs and other stocks for decades. This tactic, however, can be ruinous for the average individual investor. Why can it be ruinous? Because the investor is borrowing money that they're pledging to pay back with interest by a certain time, and they are putting that money into something that has a high level of risk. A stock can go up or down 10, 20% in a day, making it a very risky asset to put money into that you are promising to pay back. So when you borrow money and then you invest it in stocks, you're putting yourself at a great risk of going bankrupt, which companies do and have been doing for decades. But it is done because the interest rate is so low that the company is taking very little risk. They can effectively get $1 million or $1 billion for free and use it to buy stocks, and they're paying nothing for it. As far as the interest rate, if it's zero, they're paying nothing for it. So when you have interest rates that are too low, you start to see a lot more reckless, risky behavior as far as where that money is going after it is borrowed. So zombie companies, to sum it up, are companies with insufficient earnings. These are companies that should go bankrupt but stay alive. They are impervious to market signals. The market signal to a zombie company is go bankrupt or cut down your cost of production, raise revenue, do something to make your financial situation more sustainable. Zombie companies do not change according to market signals because they are supported by a government or a central bank which gives them free money or nearly free money to pay their bills. They don't have to sell anything. They don't have to improve their products. They don't have to do anything to add value to the economy. All they have to do is get money from a lender who is giving it to them for free. Or maybe not even get a loan. It can just be free cash money, such as what the government has done over the last few months. And the company that is earning nearly nothing can stay alive because it has this stream of money. It's a major factor for why there is a record amount of corporate debt. Companies are no longer borrowing to expand or to create a new device or to innovate some new way of transportation or whatever the company does. Now companies are just borrowing to stay afloat. They're not borrowing to create anything. They're borrowing just to maintain themselves. The rise of zombie companies began when the financial crisis came in 2008. It resulted in the very first major bailout in many years. So this is a graph, a chart of the amount of money that the Federal Reserve has flushed into the banking system over the past several years. Back in 2008, in early September, the Federal Reserve had $905 billion in the banking system. This is before the financial crisis really kicked into high gear. By Christmas of 2008, the balance sheet of the Fed, which is the amount of money that it has on record as pumped into the banking system, went from $905 billion to $2.2 trillion. That was the first bailout. The second bailout would come within a matter of months, or you could say would come a couple years later. Back in November of 2010, the balance sheet was $2.3 trillion of the Federal Reserve, and they decided to pump in another $600 billion so that the balance sheet would go up to $2.8 trillion in July of 2011. A third bailout would also come a few months after that. Every time the Federal Reserve senses weakness in the economy, it responds with more money off the printing press. So in September of 2012, the balance sheet is $2.8 trillion, and it pumps in another nearly $2 trillion. So by January of 2015, the balance sheet is $4.5 trillion. In 2015, the Federal Reserve believes the economy is doing well and it can start raising interest rates. And so that's what it does by the end of the year. It raises the interest rate for the first time in almost a decade. Interest rate goes from 0.1%, which is the interest rate that banks pay when they borrow from other banks, and it's set by the Federal Reserve, goes from 0.1% in 2015 to 2.4% by 2019, which is not a big increase in interest rates because the historical average is somewhere between 5 and 7%. This is an increase from 0 to 2.5% over the course of 3 years. This is not a big jump in interest rates, but it is apparently too big for these zombie companies. The Federal Reserve attempted to withdraw bailout funds that it was pumping in to the economy throughout the decade of the 2010s. And so we see now that the balance sheet in 2018 was $4.4 trillion, and the Fed started to take that money back. They started selling those bonds back to the banks that they bought, and the balance sheet went back down to $3.7 trillion. Then we have a recession. Not an economy-wide recession, but one in the manufacturing sector began in July of 2019. The Fed data shows that the U.S. manufacturing sector went into recession July 16th, 2019. 2 weeks later, the Federal Reserve panics and it cuts interest rates for the first time since 2008. And that is the reason why going up to 2.5% with interest rates and reducing the balance sheet from 4.4% to $4.4 trillion to $3.7 trillion, it was too much for these zombie companies. So they are going into recession. The manufacturing sector, we just showed you, the industrial conglomerates had the biggest bulk of zombie companies controlling the largest number of jobs. Those companies are now losing money, and as a result, the Federal Reserve had to cut interest rates from 2.4% to 1.5% by the end of 2019. It made a series of cuts along the way. The fourth bailout comes because now the Federal Reserve says cutting interest rates is not enough, and it has to jump its balance sheet back from $3.7 trillion to $4.1 trillion, meaning it's lending another $400 billion back into the banking system. Then you get the mother of all crises. The COVID-19 virus comes, and now the Federal Reserve goes back to zero, cutting rates to make money free again, because now we have government shutdowns that are causing companies to lose money hand over fist. And the interest rate goes from 1.5% down to 0 in 2020. A fifth bailout comes. This fifth bailout sends the balance sheet of the Federal Reserve from $4.1 trillion to an unprecedented $7 trillion in only a few months in 2020. This chart really shows what to expect when it comes to how long a business survives. The vast majority of businesses are not going to survive for any really long period of time. This chart goes back to 1995. And as you can see, less than half of businesses survive after 5 years. And only a third of them will go on to survive 15 years. The point of this is to show you that the vast majority of businesses will not survive. It is a fact. And therefore, it is natural we should oppose bailouts by the federal government and the Federal Reserve, because all it does is keep zombie companies alive. And zombie companies are unproductive and do not allow our economy to reap the growth that it needs. We'll see you in the next video.